Good morning. Welcome to Market Monday for December 8th, 2025. As we're coming into the home stretch of the year, things historically look good for stock market bulls in December. In fact, the S&P 500 stock market has only been down one time in December during the first year of a presidential cycle like we're in now. This is since 1985, so going back 40 years. That's a long time. If that wasn't enough, as AI Chad mentioned last week, December last year was down, and it is rarely down 2 years in a row. In fact, only once in the past 35 years. But let's not fret if the market isn't screaming higher just yet. Historically speaking, the market is actually flat through mid-month, taking off for the famed Santa Claus rally through the end of the month. Zooming out to the market so far in 2025, we see the sources of the return. Here is earnings in green, a story we've been talking about all year long. This year's gains has come from earnings, which is the highest quality source of stock market returns. Of course, we've also had multiple expansion, meaning investors paying more for these earnings here. This is the most volatile source of returns and can swing wildly from year to year. But at least this year, so far, it's also contributed to stock market gains. And over here, we see this source of that earnings growth, which comes from companies increasing sales here, but even more so from increasing their profit margins. At least for now, forward earnings look pretty healthy too. Here's the S&P 500 stock market down here, then mid caps and small caps at the top. We definitely need to be mindful here, as even though small and mid-cap companies have seemingly had higher forward earnings estimates than the S&P 500 for the last 4 years, it's the S&P 500 that's had the better stock market returns. One thing that may be different this time, here's a look at private payrolls, meaning non-government jobs broken down by company size. You'll notice that just recently, it's small companies, see right there, that are doing most of the layoffs. It's the larger companies that are still increasing hiring, though the net effect, this line here, is essentially flat, which is interesting because jobless claims, when people file for unemployment benefits when they get laid off, hit the lowest number since 2022 last week, which, right on cue, will likely lead to further rate cuts from the Fed at its final meeting of the year on Wednesday. The current target is 3.75 to 4%. And there's an 87% chance for one more cut down to a 3.5 to 3.75% range. Here we're looking at these red and blue lines. They should move in opposite directions. As red is people saying jobs are hard to get, blue is people saying jobs are easy to get. So usually when red starts turning higher and blue turns lower is when the Fed starts cutting, as they have been for over a year now, and continues doing so. So a big topic for us, and working with you, is cash management. Money markets at 5% were fantastic, but what about at 3.5%? And today we'll leave you with $12 trillion asset manager, Charles Schwab, will offer Bitcoin and Ethereum trading the actual asset, not just ETFs, in early 2026. Have a great week.